The development of central bank digital currencies is being accelerated at a rapid pace globally. But as the initiatives are being introduced, there's something I just haven't seen reported upon, and it's absolutely profound. So let's find out why and dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. In December, Sweden's central bank, the Riksbank, launched a review into the e-krona's feasibility after a pilot program at the central bank, making the Nordic country a litmus test for digital currencies and these CBDCs. The Riksbank wants the payment process to be as easy as sending a text in a process that would transform the banking system in these economies. The Swedish CBDC, the e-krona, is a direct claim upon the central bank like a note or a coin. Sweden is the least cash dependent economy in the world and is therefore leading the way among Western economies, and the government expects to reach its decision on the e-krona by November 2022 as to whether this CBDC should be introduced. And I don't think there's much doubt in the outcome. By the way, it's worth mentioning that these CBDCs are likely to be marketed in terms like e-krona or digital euro, but of course they refer to CBDC, central bank digital currencies, and full well we know that central banks prefer to hide in the shadows. The way in which Western governments are designing the architecture of these CBDCs is through a direct CBDC. That is the model highlighted in the centre of this diagram from the Bank for International Settlements. Here we can see that the CBDC is a direct claim upon the central bank. Moreover, that the central bank will handle all payments in real time and therefore maintain a record of retail holdings. This effectively bypasses the banking sector. Consequently, the chief financial officer of the Swedish SEB Bank stated that a rational household would hold its money with the Riksbank, adding that central banks offer better interest rates and protection for depositors. And so if we consider this, why would you need or want to actually hold your deposit with a retail bank, which though backed by central banks may offer a poorer rate of interest and introduces a greater counterparty risk? Perhaps most significantly is that we have a situation now where the central bank is in direct competition with the retail banking sector. This is quite staggering and is accompanied with all sorts of privacy concerns. Thus, if Swedish currency leaves the retail banking sector to be deposited in to central bank accounts, it would deprive the retail banking sector of funding, leaving them reliant on wholesale markets for liquidity. Consequently, the availability of loans for businesses and mortgages for households would be entirely dependent upon the central bank's credit risk appetite, and the retail bank's base rate would have to compete against the central bank's base rate. But how could a retail bank borrowing from wholesale markets ever offer more attractive, more competitive interest rates than a central bank and its newfound ability to actually create and inject currency directly into the economy? Over time, this would result in a debt-laden and unprofitable banking system, which could threaten financial stability. Yet banks are fundamental to economic growth, and as banking expert Richard Werner highlights in this tweet, CBDC means central bank current accounts, killing all remaining small local banks, and finally also the big ones. The Sovietization of the economy. The Soviet Union only ever had one bank, the central bank, with only the Fed left as the only bank. No more economic growth. But Riksbank Deputy Governor Cecilia Kingsley has dismissed such concerns, saying people can already exit the banking system by buying treasury bills. She states that we already have to face the risks that there are cyber runs out of the banking system. I don't think a CBDC will fundamentally change that to a worse situation, Kingsley stated. I'm very dubious ridiculous on this. Yet, as the IMF points out, a CBDC architecture based upon this approach would require legal changes. Of their 174 member countries, only 104 central banks can only issue notes and coins. But the fundamental law changes necessary for private citizens to have bank accounts with the central banks is even more profound, as we can see here, where 85% or 146 countries would require legal changes to actually facilitate this Western style of CBDC architecture. And so what is so commonly missed about CBDCs? Well, it is that China's new digital currency architecture is entirely different from that of those being researched and tested in the West, as far as I have seen, and do correct me if you find anything to the contrary. They have opted for a hybrid model outlined at the bottom of this image. Any claim is still a direct claim upon the central bank. This is an intermediate-based solution which views banks as true intermediaries. It is these banks or payment service providers who handle real-time payments. In turn, the central bank holds a copy of all retail CBDC holdings, allowing it to transfer holdings from payment service providers to another in the event of a technical failure. Now, for China, this makes sense for a number of reasons. First, it enables them to increase circulation and the international reach of their digital currency, electronic payment or DCEP currency. Second, it allows the DCEP to act as a replacement of the reserve money system while cutting the cost and friction of bank transfers. Third, it's conducive to overseas issuance of the RMB, the DCEP RMB, and reshaping the current cross-border payment system. And fourth, and perhaps most critically, it does not destroy the banking system and thereby economic growth, while offering better privacy to users. And so this is so incredibly profound. The banking system operates as a beating heart of an economic system, a banking system that can support small and medium-sized enterprises, helps to drive economic growth and employment. Just consider how the SMEs of the so-called German Mittelstand have been supported by small local banks, and how that has helped to enable such strong economic performance for the German economy. Moreover, China's approach, which requires a far more costly and complex infrastructure, allows the banking sector to specialize in what they do best, while the People's Bank of China, the PBOC, can focus on their core processes. This is division of labour and specialisation, which is likely to foster far greater economic growth within a currency system that has the potential to expand way beyond the capacity of just one institution based in one country. As this document states, such a structure can make full use of the existing currency issuance and circulation systems of commercial banks and financial intermediaries, and reduce the PBOC's related services. This enables the expansion of the payment system across its far-reaching infrastructure, neo-colonialist developments. And remember Metcalfe's law that a network's value increases as its user base increases. China's DCEP seems to be designed to facilitate increased adoption. And so while on the face of it, China and the West are pursuing CBDCs, they are likely to be vastly different in terms of their architecture and their economic significance and the outcomes that they therefore achieve. The question must be for Western central bankers is, why are you designing a system that will facilitate the destruction of a banking system, a system which you are meant to regulate rather than to compete with? Now, thanks so much for joining me. Do let me know your thoughts on this issue, because I think it's absolutely profound. And of course, in this war on free speech, I would really appreciate it if you could join my new mailing list, and you'll find the link just below for that. So thanks again, and I look forward to seeing you next time. Bye bye.